Now, here is Ticky Fullerton on Your Money.
Hello, I'm Ticky Fullerton, every night bringing you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. Coming up, how radical will the shake-up be from Kenneth Hayne's Royal Commission, and how will our big four banks come out of it? Ahead of Monday's huge release, we ask top banking analyst CLSA's Brian Johnson. And will the Royal Commission bring opportunity for new players in financial services? Chair of Startup 86400, Anthony Thomson is banking on it and joining us shortly. Healthscope accepts a bid from Canadians Brookfield. Is this the last chapter in the battle for the hospital business, or does Ben Gray's BGH have another shot in the locker? We'll find out from our markets panel shortly. And a week of results from the US tech titans. FANG lover and investor Clay Carter brings us his take on the last quarter performance of Apple, Facebook, Microsoft and Amazon. Well, now, assuming there'll be no leaks over the weekend, on Monday at 4:10 p.m, just before our next show, the government will be releasing the landmark final report into the financial services sector. This morning, Commissioner Kenneth Hayne made his way through the gates of Government House in Canberra to hand his report to the Governor-General. It is a royal inquiry, after all. On it then went to the government, a government that has resisted the inquiry for as long as it possibly could. But then came the shock revelations and the fallout, as we so well know: fees for no services, bank charging the dead, fee gouging in super, and on and on. Little wonder Josh Frydenberg wants to control how the final news comes out. Well, this afternoon we had the photo op for the Treasurer with Kenneth Hayne, no doubt accompanied by a private briefing, you'd think, from the Commissioner himself. But what can we all expect from this weighty tome? The interim report last year ran to almost 1,000 pages, and there were some clues on the Commissioner's thinking. We know he thinks that Australia's legislation right now is probably about right. It's the enforcement of our laws where the ball has been dropped. But this Royal Commission is hugely political, of course, with polls showing that most Aussies want to know that things will change radically. Some want blood, want heads to roll. And it's election time, where both sides want the cachet of being the tough guys on bad behaviour. And remember, Rowena Orr, counsel assisting, left it open on a couple of occasions this year for Ken Hayne to recommend criminal charges. Whether that happens to individuals in banks or financial services, we'll have to wait and see. What is more, the banks themselves will also have to wait as long as Joe Public will. They are locked out of the media lockup on Monday, and they're not happy about that, I can tell you. And what we all want to know, of course, is just what Commissioner Hayne recommends about firms both manufacturing and selling financial products. Does he think it's just a recipe for greed? Will vertical integration continue as a business model in future? And what about selling commissions and the broker network? Big issues there. Australian banks never had the crackdown that happened in the US and the UK after the GFC, or as they call it, the financial crisis, that threw up some really shoddy practices. Shortly, we'll also talk with Anthony Thomson, who's lived through that breach of trust in Britain and came up with a new high street bank. Now he's in Australia with plans to disrupt again. But first, let's go to our chief business reporter, Leo Shanahan, who'll actually be heading down to Canberra on Monday to bring us all the news and analysis literally minutes after its release from the Royal Commission lockup, assuming the doors open on time. What can we expect, do you think?
Look, where do you start? I mean, I think, as you said in your introduction, don't expect large-scale regulatory recommendations about new laws for this and new laws for that, because as Commissioner Haynes said in his introductory report, draft report, the laws in Australia aren't the problem, it's the enforcement of those laws. So expect a very uncomfortable spotlight on ASIC and APRA, perhaps escaping a bit more of the attention that they perhaps deserved, especially in relation to their inaction over superannuation.
Yeah, in terms of being independent.
And who's in charge of the regulation of superannuation? But look, a consistent theme throughout the hearings was the way in which customers are charged, whether that's by banks directly, whether that's by their subsidiary businesses in wealth management, in mortgage broking, in insurance, in financial planning. So look for, in terms of direct recommendations, recommendations around how customers are charged, the clarity with which they're charged, and I think, yeah, in terms of actual meaty change, you're going to see stuff around the way in which customers are getting charged. But whether that's enshrined in law or not, I think is a different question. But banks are already really largely doing this. So in a way, they're a step ahead of what's taking place because they're breaking up their own businesses. Yes. Because really, Hayne could have come out and recommended the breakup of the banks. Well, really, that's what he's doing, what they've been doing themselves as far as their business models. That vertical integration is really on the way out. Yes, yes, okay. Heads on plates? Look, we've seen scalps already, haven't we? Perhaps more than some would have thought, and in certain businesses that others perhaps weren't expecting, like AMP. You know, it was like a bomb went off in the senior management of AMP, wasn't it? I mean, there was no one really left at the end. And look, NAB senior executive Andrew Hager had to resign really as a result of this, and IWF. We've seen their senior management now taken out as a result of APRA preempting perhaps further action by APRA preempting recommendations. And just back to NAB, Andrew Thorburn is on extended leave. Andrew Thorburn on extended leave. So as a result of, you know, who could we expect to see perhaps fall by the wayside as a result? I think Andrew Thorburn could be the most likely as far as you know, one of the big four heads to go. All right, Leo Shanahan, we look forward to seeing you, talking to you on Monday for a very interesting wrap. Let's get technical now, and the financials closing into the red today. The big four actually moving mostly lower ahead of Monday's grand reveal. ANZ closing down 0.4%, Commonwealth Bank closing down 15 cents or 0.2%, NAB closed down 0.25%, and Westpac just closing marginally higher. The banks have been rocked all year by the Royal Commission fallout. You can see the financials index there, a gradual decline over the last year. From time to time, from the time the Commission began to when the hearings ended, the share prices of the Big Four and AMP have been taking a pounding. Look at this, CBA down 7, Westpac 16% down, ANZ down 8, NAB 19 down, and AMP, of course, down 53%. So, will the banks weather the Hayne storm? Don't forget, it's also results season for CBA, at least. CBA kicking things off on Wednesday. For what to expect for the Big Four, I spoke with the CLSA's top banking analyst, Brian Johnson. Brian Johnson, nice to see you. The Royal Commission, we know, has had a huge impact on banks, and banks have been moving to try and deal with the flack from the public. But what sort of impact do you think the Royal Commission might have on Monday on the sort of money-making side of a bank business model? Well, Ticky, it's interesting. When you have a look at all the bits and pieces that move around for banks, the irrefutable fact is that as they've repriced up interest-only home loans, their margins go up, and as those loans revert to being principal and interest at their end of the life, the margin goes back down. So the one thing that banks need to keep doing is repricing up home loans, and that's a very unpopular thing to do. So the biggest thing that will come out of the Royal Commission will be basically, do the banks think as we head in towards a federal election that they've got the pricing power to keep doing that? If they don't, we get margin fade. If they can keep on repricing, that would be tremendously positive. But I've got to say, the Royal Commission itself has been very dramatic. There hasn't been much come out of it that we didn't know, and there's probably not going to be really not that much come out of it we don't know. But everyone will pretend to be outraged, but it's that the election is probably the bigger issue. Right, OK, so what we're saying is, I mean, I can't imagine Kenneth Hayne being that specific about what banks can and can't do with their interest rate movements, can you? No, I can't, but I can see all the kind of, I would call it like fake outrage, because... And then putting pressure on governments to put pressure on banks. Yeah, right. Because, you know, when we think about it, as much as everyone would like to say, whose Royal Commission is this? Yes. It's the Labor Party's Royal Commission. And the Liberals are dragged 100% of the recommendations. Correct. They were dragged kicking and screaming, and you'd have to say the Labor Party looks at this stage as though
anything that comes out of the Royal Commission will basically happen.
Yes.
So, you know, the reality is, but it'll be interesting to see how the market actually reacts to it.
One part of the Royal Commission was looking at responsible lending, obviously.
Yeah.
Now, we've had various responses to that. Banks have now, almost banks like Westpac, I know Westpac and ASIC had been sort of in a standoff over this, but they, for example, have put in even higher restrictions than the household expenditure measure, the AGM. Now, I'm hearing from a number of banks that these higher levels of scrutiny on every single loan has been really one of the biggest problems in terms of them growing business and doing business, because it takes such a long time to get people over the line. Yeah,
it does. But Ticky, let's look at Australia from above. We've got $1.7 trillion in mortgage debt, of which 85% is variable rate. And as interest rates fell, households go, yippee, money will be cheap forever. I can keep on gearing myself up. What happens if ever interest rates seriously rise?
Yes.
And so when we have a look at it, that's the thing about banking.
But that's not going to happen anytime soon, is it?
Well, it's certainly not going to happen, because the RBA basically saying that the next interest rate move will be up. I don't know what planet they're on. The next interest rate move, if you're worried about housing, interest rates are going down, not up, and the A dollar is going down, not up. So there's this thing that takes away the interest rate risk. But the thing about it is, banks make money when asset values are rising, and they feel really good. I was reading in the paper today that the banks aren't responsible for house prices falling, but I'll give you the tip. They are responsible for the fact that house prices got into this incredibly bubblish territory. Yes. And a lot of the guidelines on the responsible lending were there. It's just that the banks chose not to basically comply with some of the rules. Brian
Hartz has been doing his best at Westpac, I see, to actually talk about this housing market as if it's, you know, asset prices go up, they go down.
Yeah, and there's so much pressure, but everyone's got a vested interest in saying there's not a problem. There is a problem. Will it blow up? I think it'll be a very manageable, orderly correction. And there's a whole lot of reasons for that. But there is no doubt about it, Australian house prices in September 2017, particularly the speculative bits like Sydney apartments, got to crazy levels that you could not justify. Imagine if we were sitting around and we're talking about a stock that's trading on a PE of 60 times. And basically the only way I really make great returns on it is that I just massively increase my borrowing against it. So the value moves up a little bit, but I really make my money through leverage. And that is what housing was in Australia.
Gotcha. Okay. Another possible change that Kenneth Hayne might recommend, which would be dramatic, would be some sort of end to vertical integration. What impact would that have? Now, in other words, your manufacturing of your products and your selling of the same products, you know, no more.
2 years ago, I would have told you that would have a big impact. Right now, I tell you, I don't think it'll have a very big impact at all, because they're bailing on those businesses like there's no tomorrow. We've had a Commonwealth Bank sell Colonial First State Global Asset Management. They sold their life insurance business. They're reviewing basically their general insurance business. We've had ANZ basically exiting theirs. They're exiting these businesses. So I don't think that is really that significant, because they can see the writing on the wall.
Yes.
Banks are not natural owners of some of these other businesses. The capital doesn't work.
But if you like, Hayne has actually driven that anyway.
Yeah, well, there's been a whole lot of things that should have been driving it, but I think it'll be more significant from a competitive viewpoint about what they recommended about conflicted commission structures. We've had any number of reviews that have basically spoken about some of the way the commissions are paid internally and externally in Australia, some of the behaviour that creates. I think Hayne will actually recommend that we move to a flatter commission structure. For example, for mortgage brokers. That's not good for mortgage brokers, that's probably good for banks, but it does entrench the competitive advantage that the banks have got. So it's kind of negative competition. And that's why the interesting thing about it, Ticky, is if I was to go back to the financial systems inquiry that came out in November 2014, not all of that has actually even happened now. So it will be, you know, we're going to have a lot of people saying, oh, all this stuff is definitely going to happen. And then I'll wait and see as to whether it actually does happen.
Yeah. Let's look through the Royal Commission. Of course, next week we've also got some results coming out from the Commonwealth Bank. What you're expecting there? I think it'll be a great result. Do you? And the reason I think it'll be a great result, Ticky, is they were the first into this kind of outrageous customer remediation cycle, let's get everything right. And they've taken a lot of that through the profit and loss account. Yes. They've also taken a lot of the regulatory costs.
And they've actually called that out in their last result. But over and above that, if you're going to have a bad result, you may as well have a really bad result. So the last result, they wrote off a bit of capitalised software. They had a massive restructuring charge on some 30-year debt they took a lot of stuff through the cash earnings.
Meanwhile, they've moved their rates, haven't they?
They've moved their rates. And the other thing about Commonwealth Bank is the Royal Commission itself and Austrac and everything else has been a tremendous distraction. But when you have a look at the market shares figures that are coming through, Commonwealth Bank is actually starting to hum again. So Commonwealth Bank, it's Australia's best franchise. It's got Australia's best deposit base. Deposit margins are improving.
It's one of the most exposed, of course, to the mortgage market, isn't it? But then, as you say, rates aren't heading up dramatically.
And the other thing about Commonwealth Bank that I really like, there are two things I don't think the market... I think the market didn't look at all these things they took through the P&L last time. But over and above that, there's a tremendous cost-out opportunity. And then over and above that, the amazing thing is they are selling Colonial First State Global Asset Management on a PE of 17.5 times. The bank's trading at about 12. So unlike ANZ that are selling stuff cheaply to actually buy back the headstock expensively, Commonwealth Bank, we open our way up for something unusual, which is accretive capital management. And the final thing on CommBank, because mum and dad retail investor are so sensible, they own so much Commonwealth Bank, institutions don't own it. And we saw this play through in the fourth quarter. ANZ was down 9%, NAB was down 8%, Westpac was down 5%, and Commonwealth Bank was up 3%. I think it's the beginning of the resurgence of Commonwealth Bank.
Okay, wow, that's a good call. Now, National Australia Bank, Andrew Thorburn, of course, has been out for some time now. Will he return?
Look, the thing about it is that when we have a look at NAB, NAB has operationally underperformed for decades. Like not a year, not 2 years, but it's operationally underperformed for a long time. And when we actually have a look at the restructuring initiative that they've announced, you don't get the big payoff until 2021. And given its track record of poor execution, people are very cynical as to whether it will actually happen. Whoever is the CEO at NAB is an interesting point, but I would flag to you, it does strike me as rather unusual to have the CEO basically take long service leave. That's not the way it normally works for a bank. So we'll have to wait.
Especially right now, given what's going on.
And so the thing that I will be most aware of is the Royal Commission performance hasn't been too flash. The share price performance hasn't been that amazing. The operational performance, a lot of the benefits are basically a long way deferred, and that is in the share price now. But they need to actually start delivering. Shareholders deserve better. But I'm also positive on NAB.
Yes.
Although part of me says it's always a value trap, I think it's really cheap. It's the second one that I would basically pick.
Briefly, what do you think, what are your international investors telling you about the banks? And indeed, let's include Macquarie as well. Okay.
Ticky, what they are telling me, the 4 Australian banks peaked in May 2015, and ever since then, they have massively, massively underperformed. So, for example, in Australia, they've gone from being 33% of the ASX 200 now to being kind of like 23, 24%. They have massively underperformed for a long time. International institutions are massively, massively underweight, and that is a risk. Now, there is no data at the moment that seems to be coming out of China that is particularly positive. And so what that might mean is perhaps people will want to skew their Asian portfolios to something they feel is probably a little bit safer. And the Australian banks, which have underperformed for so long, probably look that little bit safer. So to give a small example, in the December quarter, banks down 4.5%. Normally we'd be sitting around saying, oh, banks, that's not very good, they've massively underperformed. They outperformed because they did less bad than the rest of the market. And as we head into this reporting season, I think people should genuinely be fearful that as banks reprice up home loans, the money comes from somewhere. It comes out of discretionary consumption. So perhaps the Australian banks feel a bit safer. So what I'm certainly spending every night of late is on long, long conference calls where we talk about how the real risk is that everyone is a little bit too miserable.
All right, McBank, very quickly.
They will have an operational briefing on the 12th of February. I personally don't think they will upgrade the guidance further. But as recently as September 2018, they were saying earnings would be broadly in line.
Yes. Broadly
in line became up 10%. It's now up 15%. They don't need any more earnings. I think they'll be hiding earnings.
Yeah.
But what I expect to come out of the operational briefing is the amazing growth in the Macquarie infrastructure and real assets infrastructure fund business, which is a very valuable business.
Yep.
I also think this thing about renewable energy is massive for them. And the final one is this very cold weather we see in the United States at the moment. What they've built in this US natural gas trading business is something phenomenal. So that remains my favourite stock.
Brian Johnson, thank you so much.
Thank you.
Yes, a big bank fan there. After the break, we'll get more expectations for the release of the Hayne final report on Monday with veteran banker Anthony Thomson.
You're watching Ticky on Your Money. Now, back to Ticky.
Yes, welcome back. Well, for all those waiting for the drop from Kenneth Hayne, it's worth looking back at what was done in places like Britain after the GFC crackdown by regulators and just what emerged after that. Well, Anthony Thomson was right in the thick of it in 2008-9, and by 2010 he'd founded a new high street bank with branches. Britain's first new bank in, I think, about 150 years. It's called Macrovue Bank, which has gone on to be remarkably successful. Now, then he had another one in Britain called Atom, and now he's here in Australia as chair of startup 86400, a new disruptor in phone banking. Well, like all disruptors, he's got a keen interest in the Royal Commission. Anthony Thomson joins me now live at the desk. Anthony, welcome. Hi. Now, look, I called you a banker before the break, but actually you're not a banker, are you? You're a sort of an entrepreneur.
Well, I'm a marketer by background, so my interest has always been in consumers.
Yeah, and you've raised money.
Yeah, about $1 billion over the last 11 years for two banks. $1
billion, right. OK, so this, I'm imagining for you out here now, and you've moved out here. Yep. This must be a bit déjà vu for you as the Hayne report comes down after all this.
As Yogi Berra said, it's déjà vu all over again.
Exactly.
So back in 2008, 2009, we saw exactly the same behaviours by the big banks. And if I could characterise it, I'd say the problem stemmed from the fact that the big banks lost sight of their customers. They think that they only existed to make money. And all of the bad behaviours we've seen over here,
and I suppose expectations were all around what the shareholders wanted?
Yeah, the banks thought that the only thing that mattered was shareholder returns, which I think was a very short-sighted view. My belief is that profit is a byproduct of doing something well for the customer.
How did the regulators respond?
They loved it. They loved the idea of putting the customer first, because all of the behaviours of the banks had been to put making money first. Yeah. And thus we got customers who were very badly treated. They were ripped off in terms of products and services and charges. Yeah. I don't think in the UK we actually managed to charge dead people. Yes. I think that's something you've managed in Australia that we weren't able to.
So how tough, and what sort of things did the regulators do? What was enacted to curb this behaviour?
Well, there was a lot of legislation brought in.
Yeah, new legislation.
Yeah, which to some degree doesn't change behaviours, because ultimately the problem is a cultural and a behavioural problem. And what we saw in the banks in the UK, and what I think we've seen with the banks here, is if they don't change their underlying behaviours, if they don't put customers first, they'll just find a way around the regulation. And one of the problems we saw was we had this massive mis-selling scandal. Yes. The compensation is running to £19 billion. That's probably $30 billion. And no single person has ever been held responsible. So what they did in the UK, and what I'm delighted to say the regulator's done here, is introduce a regime which says, I want to know what your job is, and if something goes wrong there, I'm going to hold you responsible.
This is BEAR.
This is
the bank executive accountability thing.
Regime,
But that's been given to APRA, to police.
Yeah.
Now, that's a bit odd. Do we think we're going to get... Because the cop on the beat really is ASIC. Yeah. Do we think we're going to get some clarity over who's who in the zoo among regulators?
Well, I think, in terms of, to your earlier point, what's going to come out of the Commission on Monday, I think we're going to see the regulator or regulators get more teeth. Yeah. I think they're going to have more powers. Hayne intimated very strongly in his interim report back in September that he didn't see the solution as more regulation. He saw the solution as the regulation that exists being properly enforced.
What about changes to business models? Because we've just had Brian Johnson on from CLSA. Now, he was saying, look, if Hayne decides to do something about, say, selling and the mortgage market, and it hits brokers, potentially that could be good for the banks. It could make the big four banks actually stronger. Do you think Hayne would have that at the top of his mind?
I think everything I've seen and everything I've read about him suggests that he's scrupulously fair in the way he's approaching this. But there's always the risk of unintended consequences. Mortgage markets work very well when there is a highly intermediated sector. Brokers who look after you and help you sort out the incredibly difficult morass of mortgage offers that are out there.
Yes.
So I think it would be good to ensure that those mortgage brokers are working from a level playing field, that they're not being incentivized financially to recommend one company over another, that their recommendation is purely based upon what's best for you or me.
Yes.
So I think regulation
But that's
like that
a
would be
big
good.
change to things like how platforms work and all that sort of stuff, isn't it?
Yeah.
But you see that as a possible outcome next week?
Well, unfortunately, my crystal ball's a little cloudy. I think it is. Distribution is clearly an issue.
Yes.
To your point, but it's more around sales culture.
Yes.
I think this is the issue. As long as people are rewarded for selling customer things, they're not going to work in the customer's best interests. And you mentioned Metro Bank in the UK. One of the things we did which changed banking in the UK was we said no one is going to get paid to sell anybody anything. And people were,
so you had advisory fees?
No, we said all of the people who work in the bank, the people you meet when you walk through the door, the greeter, the teller behind the desk, they only get paid for giving high levels of customer satisfaction. They don't get paid for selling anything. Right. And we started that with one bank in one branch in London, and it changed banking. Today, in the UK, the big banks don't reward people for selling things. And I think that would be a welcome change to come here in Australia.
All right, tell us about 86-400, because it is...
Well, very exciting, yeah. We think it's a great opportunity to really put the customer front and centre, to deliver them a bank when, where and how they want it. We're going to do that through mobile devices, so you can do everything you need on your phone, open an account in 90 seconds.
86-400 being the number of seconds in the day.
Number of seconds in a day, exactly, yeah. And it came from a great piece of work we did that said, we think most people don't like thinking about money. Most people are worried about money. They have a very difficult relationship with money. So we said, we should be thinking of money every second of every minute of every day, using big data and data analytics and artificial intelligence to help you, so you don't need to worry about it. And somebody said, 86-400. We said, what's that? I said, every second of every minute of every hour of every day.
That's very good. That's very good. So you're is it actually up and running now as a business?
We are working fully as a bank. We're waiting our final licensing from APRA, which we believe will be in the next few weeks. Yep. And then we'll be live in the market sometime in the next quarter.
So APRA is actually beginning to dish out these licenses now, isn't it, to disruptors?
Yes.
So we are seeing, yes, a much, a real choice just beginning to emerge.
And the most important thing, regulation isn't going to change banking behaviour. Competition is going to change banking behaviour. More banks, providing they're different, no good if they're all the same.
Yes.
But more new entrants, giving people more choice, better products, better services, better experience, will encourage people to move, and that will change the behaviour of the big banks.
Can I just come back to Hayne for a moment, and indeed back to what happened in England? Heads didn't roll in England, did they? Individual
no, because it was prior to our equivalent of this BEAR regime.
Yes.
There was no individual accountability.
Yes.
That has since been introduced. I think it's a great thing. I think it's great that it's introduced here in Australia. And I think going forward, we will see individuals held accountable for bad behaviours in banking.
And do you think the culture has changed in Britain?
I think it has, not as much as it needs to. And I think the challenges that have entered the UK market, and I was part of two of them, have helped change that. And I believe that challenges in this market, 86-400 obviously being one of them, will change the market.
Yeah. And at the moment, who owns 86-400?
We are 100% owned by a company called Cuscal, who are the 5th most systemically important bank in Australia that nobody's ever heard of.
Yeah, and who are they? So tell us about them.
They provide payment services to over 100 Australian institutions, the payment rails, payment gateways. They put 40 Australian banks onto Apple Pay.
Yes,
so
and who owns them? Who backs them?
They have 15, I think, shareholders, maybe a couple more, a number of the regional banks and one of the big card companies.
Right, right. Okay, well, as we're talking, I think ME Bank is just hiking home loan rates by 15 basis points, so that's pretty interesting as well. Just heard that through my ear. So anyway, look, I think it'll be a very interesting time. Come back and talk to us about how you're going in a couple of months, and we'll see what it's like in the new environment post-Hayne. Anthony Thomson, thank you very much. Right, well, after the break, we'll get a wrap on this week's big market moves with my first markets panel of 2019.
This is Ticky on Your Money, covering the big business stories.
Welcome back. Well, let's go to markets now. And quite an interesting development with Healthscope today. They've now agreed to a formal $4.5 billion takeover bid from Canada's Brookfield Capital Partners. But the marathon takeover battle may not be over yet. Rival BGH Capital has confirmed it's willing to improve the terms of its previous offer of $2.36 a share. Still, some analysts say the battle is likely over after Brookfield's superior bid of $2.50 a share was accepted by the board. Now, it comes as the first half EBITDA growth jumped 7.7% to $198 million at last, up from $183 million last year. So a much rosier picture there. So for more on this story and for a wrap on this week's big company news, pleased to welcome my first markets panel of the year, Michael McCarthy from CMC Markets and Anne Bowering, Managing Director at the National Stock Exchange. Welcome, guys. Now, Anne, tell me, this is quite a big development, isn't it? Because Paula Dwyer, Chair of Healthscope, was sitting there and she has now gone for Brookfield.
Yeah. Oh, look, it's been a mammoth 9 months, I'd say, on behalf of Paula and her board. It's been a fantastic effort to take the company from what they termed, I guess, as being a non-offer, a non-bid coming in there to transform that to being this competitive, almost tender process now with three bids on the table.
Well, they had a really wobbly moment, didn't they? Because they were trying to tell shareholders, wait till we've opened the Northern Beaches Hospital, and then that had a really wobbly start as well. But now, for the first time in a long time, they've exceeded expectations.
Yeah, and look, it's a fantastic position for the shareholders to be finding themselves there with the choice there to make between multiple offers on the table. So
all right, Mike, what do you reckon about this? Isn't it like the most? It's a very, very high price for multiple for a health asset. I think the highest ever.
Well, it depends on your earnings estimate, doesn't it? And that's one of the limitations of PE multiples. We only look at next year's earnings, and if there's a big growth rate beyond that, then it might be a very cheap price in the end. And at this stage,
presumably that's possibly one reason why we've got these interested parties.
That's almost certainly it, especially two bidders.
So look, there's a big difference between the prices now. I mean, there's commentary that I see our colleague John Jury saying Paula Dwyer has actually blinked, allowing Brookfield to cut its proposed bid for the company by over 3% to $2.50. Is that how you read it?
Well, it's quite complicated, and this is the thing about it. They've actually got two bids. There's a takeover bid at $2.40 plus your dividend, and a scheme of arrangement at $2.50 where shareholders can elect to take unlisted shares in the new entity. So it's a little more complicated, and yes, they have backed off a bit because that $2.50 now includes a 3.5-cent dividend. So it is
nevertheless it is quite a substantial bid. Where do we think it's got to be voted on, though, by shareholders, doesn't it?
And let's remember, BGH have 19.9%.
Yes, but where does that leave Aussie Super? Because they're in partnership with BGH, and yet presumably there's a new level of pressure on them now to go with the board, or would there be?
Well, I mean, there's a challenge there in terms of making the right decision for their investors based on the offer versus a broader strategy there. So there'll be interesting discussions in their boardroom, I think, about what strategy they need to take. Well,
and they've gone out and committed to do everything with BGH, though, haven't they? They're not going to be. They're not allowed to be a party with anybody else, for example.
Exactly. So it's an interesting situation that they find themselves.
All right. Well, we'll keep following on that one. Now, I did mention that ME Bank literally minutes ago has announced a hike in their rates. I said 15 basis points. It's actually 18 basis points. But we are staring down the barrel of Hayne now, coming to us on Monday. Michael, what is the market saying about the impact on banks?
Well, the market's very cautious. We know that bank prices and financial shares have been marked down substantially since this Commission of Inquiry was announced. AMP, the hardest hit, given the revelations that have come out over the past 12 months, its shares are down more than 50% since it started appearing, whereas across the financial space, we're looking at an overall decline of a bit more than 20%. So shareholders have already moved ahead of this, and we are expecting to see change in the space. There will be increased regulation, and that means increased costs. But how much of that is factored into these lower share prices is an open question. A number of traders put it to me today, we might actually see a bounce in bank share prices next week. Because
we've got CBA next week, of course, the results.
Absolutely, so it would be a big week for banks no matter what. But with the certainty that comes with knowing what the costs will be, or once the reports are released to the public on Monday afternoon, the analysts will be able to cut their numbers and they'll be able to quantify what we have,
we know
what's been uncertain for so long.
Anne.
Yeah, look, I think what's really interesting looking forward to Monday is the potential impact on competition in the marketplace. So we have a really vibrant consumer-owned banking group in Australia who are sitting here looking at down the barrel of a one-size-fits-all solution here. But really, I think that group of banks could play a really important part in the solution that we're looking at in terms of getting better customer outcomes.
Briefly, TPG, what do you reckon? They've very interesting pulling back from 5G. Do we think the merger, which will presumably be helped with this, with Vodafone, will be going ahead now?
Oh, look, I think, the questions around the impact on competition for that merger, obviously that sits with the ACCC at the moment, so that's sort of a decision for them to make there. I think that, it's another instance of regulation impacting markets here. We've got, government's decision taking a position around foreign investment and how that's impacting corporate strategy. So it's been really interesting to see how that plays out.
Michael, good play by TPG?
Brilliant play. They've removed one of the ACCC's major concerns. And it was, I must admit, I scratched my head when the ACCC told us they were concerned about the impact on future competition. In other words, we all knew TPG didn't have an extensive mobile network, and the ACCC was concerned about them not going ahead with their plans. In taking those plans off the table, presumably they've wiped out that ACCC concern.
And they weren't going anywhere with their Huawei technology, so that was all right. Well, Michael McCarthy and Bowering, thank you so much for joining us.
Thank you.
Should just add that, that John Brumby, chair of Huawei Australia, has actually resigned today. He said it's more about the fact that he is Chancellor at La Trobe University than anything that's gone on with Huawei recently. So take it as read. Right, e-commerce giant Amazon failing to meet expectations for the quarter with a 20% jump in sales. Not enough to keep investors happy. For more on those results and of FANG and some analysis of the whole fourth quarter results of FANG, actually, I spoke with Clay Carter from Macrovue earlier. Well, Clay Carter, for those investors who've been in FANG stocks over the last 12 months, what does this last quarter say?
Well, I think certainly investors have been, somewhat impressed by the earnings that the companies have generated in Q4, and of course, we had a big sell-off in the markets in the last quarter of last year. These stocks, were sold down pretty hard. So they had something to prove, and I think generally they did show that they're still executing well, that the growth is still there, and that a number of investor concerns are probably misplaced. Okay, well, we've had a few out this week. Most recently, of course, Amazon. Now, the company actually beat analysts' earnings and revenue forecasts, but outlook a bit soft. Yeah, their guidance was, I think, 56 to 60 billion in Q1. The consensus was around 60 billion, but I don't think you have to be too concerned because normally Amazon is quite conservative. Q1 is not necessarily a great quarter in North American retail or Northern Hemisphere retail, so yeah, I don't see a lot of problems. And what about really? Amazon Web Services, what about the cloud business? Because of course that is such a driver now. Yeah, that's a huge growth opportunity for them, and they've got a huge runway with AWS. Has great margins, still growing 45% year over year. They're so far ahead of the other competitors, Microsoft and Google, that I think they've got 5 years of incredible growth, and the value of that franchise is really something.
Okay, now what about Satya Nadella at Microsoft? I mean, he really feels cloud is his new space as well with Azure. How did Microsoft go? Because I think investors over the year, that the shares have gone up quite considerably, haven't they?
Yeah, well, I think Microsoft had some problems with getting chips for the data center, so that was a little bit of a worry. But I mean, Azure is still growing, again, 76% year over year. They play in a slightly different space than AWS, but certainly, that business for Microsoft is doing well. The Office 365 business is doing well. Surface, their tablet business, is doing well. The last couple of quarters, Microsoft's had a nice beat. This time they kind of came in line, but again, as a Microsoft investor, I don't have any problems with the result. The guidance was okay.
You mentioned the chip. You mentioned the chips there, Clay, because obviously that reflects the ongoing tensions between the US and China. How do you see that impacting the company going forward if these tensions continue? And indeed, if we get a ratcheting up on March the 1st? Well, I'm hoping that I'm one of the more optimistic ones in terms of I think that the U.S. and China will sort out a good part of their trade differences. So I don't see this necessarily affecting companies over the medium to long term, but it could over the next quarter certainly. And Microsoft demonstrated that. Other companies like Qualcomm obviously have other issues with China, and that'll have to be resolved in the next few months as well. Okay, well, let's move to Facebook and Apple. Now, Facebook came in now despite some of the big trust issues that it's been dealing with. The market still loves it. The earnings seem to be very strong. Yeah, I think Facebook really showed that advertisers still want to advertise on Facebook. They're willing to pay more for ads. And that the daily average users and monthly average users, it's still growing. People have not been fleeing the platform. Even your European users went up in spite of the GDPR regulations in Europe. So yeah, look, I think for Facebook investors, it really gave them a lot of confidence that the company is still executing well. They're not out of the woods. The regulators will still be looking at them. But one thing that came out of the call was Mark Zuckerberg said that they'd increased their headcount something like 42% year over year, and the majority of those people are being involved in security, fake news on the platform side to prevent election manipulation, that sort of thing. So they're obviously taking it very seriously, and they're putting their money where their mouth is, really. Yeah, plenty of upside, you'd think. After the break, we'll stay stateside and get the latest in US politics with former White House advisor Ed Blakely next.
Now, back to Ticky.
Yep, hello again. US President Donald Trump says he remains optimistic about a trade deal with China, but signalled there could be delays. Mr. Trump says he would either strike a very big deal with China or postpone it if negotiations fail to include sweeping changes to China's economic policies. He said the decision would ultimately come down to an agreement between leaders.
We've been dealing with China. We've had a great relationship. I have a great relationship with President Xi. The relationship of my people to Chinese representatives has been very good. They're negotiating now. They'll be coming over here at about 4 o'clock. I think that probably the final deal will be made, if it's made, will be made between myself and President Xi.
Well, according to President Trump, President Xi said in a letter to the White House that he wants to reach a trade agreement before a March 1 deadline. Comes as Chinese leader Xi Jinping confirmed he plans to meet the US halfway on trade. US Trade Representative Robert Lighthizer is leading a second day of negotiations with the Chinese Vice Premier. And for his insights, I spoke with former White House advisor Ed Blakely a little earlier. Ed Blakely, well, we've had the Fed Reserve a decision on rates this week, but I want to talk to you about politics. Let's talk Trump and first his meetings pretty much right now with the Chinese. Are we going to see some sort of resolution or at least some good news on the trade tensions?
Well, I think the decision was baked in. I don't think he's going into this meeting without the decision having been made earlier. And the Chinese are going to back off. They're going to back off on intellectual property. You know, one of their people is being held in Canada now for the United States for a violation of intellectual property.
Yeah,
they'll probably let her go,
the
Huawei. They'll let her go in exchange for them being more rigid on the intellectual property thing. U.S. intellectual property will then go into China, and the soft stuff will go into China. China needs to send the hard stuff to the U.S.
Yes.
The chairs, the television.
So this is good news for companies like Qualcomm?
Yeah, for Qualcomm and all those companies. Yeah. They'll be doing all right on the back of this. The problem with this is when Trump makes a big deal, it's not for the United States. This is a Trump deal. What happens when a new Congress comes or a new president comes? He doesn't think about the United States as a strategic entity. He thinks about himself.
What about all these tweets that have been coming out of the White House and Donald Trump, particularly on the wall? We've got to call the wall for what it is, a wall.
Well, the wall's a wall, and it's a wall of words right now. The president will change the words for a gate, whatever. He needs to get $5 billion. I think what we're going to dance around are the dreamers, the people who came to the United States with their parents and don't have citizenship. And the president wants to wash his hands of that one by kicking it over to Congress. The Congress gives, let's say, 600,000 dreamers, and there's a $3 billion wall.
Yes.
And I think the wall will come down to $3 billion over several years, so it doesn't break the bank.
Yeah.
And it won't be a wall. It'll be all the things the Democrats are talking about, protections at airports and stuff like that.
Yeah.
And what wall there is will be repair of the existing wall.
But there'll be enough face, presumably.
This is all faceplant.
Yeah.
You know, he would be a great president of China because he's into not losing face.
Well, hopefully that's why there'll be something done on trade. Now, I should also ask you about Mr. Stone and the ongoing investigations and all the Russian conspiracies. Where do you see the latest developments in this Stone saga?
Well, I think Mueller's at the end now. This is the last piece. Who worked as a go-between with WikiLeaks and the campaign?
Yes.
And Stone has been selected for this. But my own feeling is Stone is too clumsy and too silly to do a job that important. And the Russians are glad they're dangling out there. There's somebody else really big who is in this piece.
So Stone's not particularly helpful to Mueller?
I think what he's doing is using it as a kind of cat and mouse game.
Yes.
I've got the little mouse here, and I know the cat's there, so somebody better give him up. And this is scaring the cat for sure, that I may be done in. I think there's somebody else bigger, names we already know, that were the go-betweens with the Russian.
Right.
And one of them may already be under control of Mr. Mueller.
Oh, right.
Yeah,
Care to mention a name there?
Well, he may have been in the military. Let's leave it at that.
All right. Another big date with North Korea. Is that, again, just for the domestic audience, really?
It is. And the president doesn't believe his intelligence community knows what's going on in North Korea. Now, that would be a budget saving right there. Just get rid of all the CIA and all those agencies, and you could build all kinds of walls. This is a bit silly. Trump is being played by the North Koreans. And there are two levels here. One of them is the North Koreans aren't giving up any nuclear weapons. But the other is, which is a good thing, they're dealing with South Korea. And they're building a partnership here. And I think we're going to see a little bit of an East German thing where the border comes down and the North Koreans keep some weapons to protect the entire peninsula. And there'll be kind of a co-governing arrangement. That'll be a good thing for the world because everybody has something to lose. This is good news. I think the president's going as good news, but he's not going to do anything. Pompeo's already, again, baked that deal in.
Yes. All right. Well, good news. Possible wall coming down effectively between North and South of Korea and not really going up very fast in America. Ed Blakely, thank you very much.
Thank you.
Well, that's all for the show tonight. We'll see you next week, a whole 20 minutes or so after the Hayne final report is released to the public. We'll be crossing live to Leo Shanahan, who'll be giving you all the details. Also talking to Small Business Ombudsman Kate Carnell, who'll be in Canberra after the lock-up. We'll get small business response from the Hayne recommendations then. Until then, of course, lots more. Thanks for your company.